Hello and welcome to episode 427 of the Money to the Masses podcast with your resident expert as always, Damien Fay, and me, Andy Leaks. Damien, welcome back. How are you doing?
Yeah, I'm good, Andy. In fact, a bit of admin before we start this week, because it's the last time that you and I are going to see each other, aren't we, on the podcast, because you're taking a mini break. So we are doing a special show next week, which is going to be all about teaching children about money. So various different ages. We're compiling some of our best bits in the past. We're top and tailing that. So that's going to be something to look out for. A nice link with children going back to school. So in the meantime, keep the reviews coming in. We always ask at the end of the show. So I'm doing it at the beginning of the show this week. Do make sure that you leave us a review that we can read out in the coming weeks. The best ones will be getting a Money to the Masses mug.
Okay, so that's the formalities out of the way. What have we got coming up on this week's podcast?
So there is quite a lot on this week's podcast, so I'm going to have to try and squeeze it all in. I'm going to do a piece on the Dunning-Kruger effect. So it's a phenomenon about what is often associated with the phrase, a little knowledge is a dangerous thing. So I'm going to explain why that isn't necessarily the case and what it means for you as investors. I'm then going to do a piece on consumer duty. So there's a new principle that's come in from the FCA, which is really significant for regulated firms. But I don't think consumers really understand what's going on. We've been doing a lot in the background, speaking to people regarding what it means for firms that are regulated by the FCA. And therefore, I wanted to do a short piece on the podcast so consumers can understand what it means for them. And I'm also going to be doing a piece on joint savings accounts. It's a topic we've never covered before on the podcast. So we've been doing almost 500 shows and we're always finding new topics. Joint savings accounts. I want to touch upon the pros and cons of them, but more importantly, some examples of joint savings accounts out there, because there aren't as many as you think. So they're quite difficult to find.
Okay, so let's start with the Dunning-Kruger effect then, Damien. You're going to explain what it is and why it's sometimes misinterpreted.
So some of the most popular pieces we do on the podcast, particularly in relation to investing, are regarding behavioural economics. So biases that we have as humans that make us good or bad investors. And this piece links back to a study that was published by David Dunning and Justin Kruger in 1999. And it gave birth to something called the Dunning-Kruger effect. Now, if you search around online, you will find various different definitions or interpretations of what that research actually told you. But to give one example of a definition, it is a cognitive error that indicates that people with little experience and knowledge in a given field overestimate their abilities. And it's often associated with that phrase, a little knowledge is a dangerous thing. And the reason I want to talk about it, because it is often used in the investment world, and particularly in the financial services world, as a means to sell services and products to people. So the idea being, there is a chart that you may have seen, and it's sometimes referred to as the Dunning-Kruger curve, or I've seen it referred to as Mount Stupid, which is a chart where on the axes are confidence and competence. So imagine the x-axis, that's the one going on the bottom horizontally, is the word competence, and on the vertical axis, the y-axis, is the word confidence. So you might think that as your competence in an area goes up, your confidence also goes up as well. What the typical chart that you will see published in material or blog posts or anything online is a line that initially almost goes vertically. So it suggests that people's confidence almost grows exponentially with a very little bit of knowledge. Then their confidence peaks at what they would call Mount Stupid. I don't like that term, but that's what it's often known as. But then it very rapidly drops when they realise, as their knowledge increases, that they don't know as much as they should do, and reportedly then start making mistakes. They then hit a valley of despair, and then as they start to learn more, their competence in an area starts to increase, their confidence starts to increase slowly, and then they start going up this slope of enlightenment to a plateau of sustainability. A lot of buzzwords, but what it means is typically over a long period of time when they become an expert, then their confidence returns towards those levels that they may have had at the initial burst of knowledge. So You will see this thrown about as a reason why when people start maybe investing, a little knowledge is a dangerous thing because they find out a bit about investing, get very excited, they become overconfident, start investing in the markets, making mistakes, and then they end up losing lots of money. Now, there is some truth in that. We've seen that in the pandemic. So during the pandemic, there was a big wave of new investors that joined the market. So as I mentioned, I think it was on last week's podcast, if you went back and looked at various different platforms out there and you looked at their results, they acquired lots of new customers, but customers that were trading. And so they were buying and selling shares. They hadn't done so before. Lots of them eventually lost money because they weren't patient enough, or they were effectively speculating rather than investing. So they were almost gambling. They lost their money and they've been burnt and have left the investing arena quite sadly because they've hit that valley of despair that I mentioned. But unfortunately, they're probably not learning about investing again, improving their knowledge. So if you take the usual interpretation of this Dunning-Kruger effect, it's basically if you don't have enough knowledge, then you shouldn't really be investing, if we're looking at the investing angle, because you could do something silly. But the Dunning-Kruger effect, it didn't actually say that. If you go back to the original research, there were two variables which they studied, and they were performance and self-assessed performance. And it was across a range of different areas. And there's been studies that have been carried out since that cover even more areas. But back then it was things like logic, grammar. So what they would do is they'd get people who would take a test, for example. They would then assess the performance of those people in those tests. But then they would go back and ask the people what they expected their performance to be. They made an assessment of how well they'd done without any reference point to how well they had done. They hadn't seen their score. And then they looked at the difference between what people actually achieved versus what they thought they had achieved. And this is where this Dunning-Kruger effect came from, because what they actually found was that the majority of participants overestimated their knowledge relative to their peers. So they overestimated how well they had done in the test. So that is not surprising in some ways. It's one of the reasons if you ask somebody if they're a good driver or bad driver, most people will say they're better than average. And they found that in these tests. So if you think about it, you ask most people, they will all say they're a good driver. I've not met anybody, I don't think, who admits to being a particularly bad driver. But the other thing that they discovered is that, yes, as people performed better, so in the test, those who performed better, there was a positive correlation between their perception of how well they had done and how well they had actually performed. But the differential between those with the lowest performance when compared to those with the highest performance was greater. So typically, the people who were in the bottom 12% of performers estimated they were in the top half. And then as you moved up the scale, that differential reduced to the point where those at the very top, so the top performers, typically underestimated how well they'd performed. So what you have is at the top end, you have people who start to think, well, if they've performed well, their judgment was clouded by the fact that they perhaps found it easy. And so therefore they'd assume everybody else found it easy. So therefore they'd assume their performance relative to everybody else was lower than it actually was. But the other end of the scale, those people who actually performed the worst were the people who were the most optimistic about their performance. Now, if you listen to this, you're probably sitting there thinking, I know a whole bunch of people in the workplace who are like this. And maybe it is something that's inherently in humans to protect our own egos, where if we're not particularly good at something, we seem to overestimate our own abilities. But there is a weird irony in this, that in order to make an assessment of how well you performed in a test, for example, you've got to have a certain baseline knowledge. Because if you don't know anything about mathematics, for example, how could you say whether you've done well or not if you didn't know the topic particularly well? So there is some element of the research that is open to debate because of this slight irony that you can only judge your performance on a topic, for example, if you actually have any knowledge of that topic. But the point is that it wasn't a test that proved anything about stupidity. It was really about incompetence, but it really showed the misconception of poor performers and crucially not beginners. So we're not talking about in an investing space that if you are a beginner with little knowledge that you would therefore perform badly. That isn't actually what the research showed. It's given birth to a lot of this idea that a little knowledge is a dangerous thing. What it showed is the people who performed the worst, not necessarily that they were beginners, the worst performers overestimated their abilities. So that is something to bear in mind, because when you take that to the investment space, it doesn't mean just because you aren't as knowledgeable as somebody else that your performance will be guaranteed to be be any worse. Now, there has been subsequent evidence that does show there is overconfidence in beginners, but not to the degree that people quote. And that's understandable because obviously if people are new to something, whether it's investing or another area of life, then they may have a bit of knowledge, and if they apply that in some way, it can lead to negative or detrimental results. So why am I telling you all this? What is the takeaway? The first thing is that you need to be realistic about your knowledge, and it's the importance of continually learning. So if you learn about the topic, which is one of the reasons I do things like the podcast, we produce Money to the Masses, articles, etc., is that if you continually learn, that will improve your knowledge, and hopefully that will improve your outcomes in the long run. But what it does do, it increases your ability to realistically assess your performance when it comes to whatever you're trying to do, whether it's investing, whether it's decision making, for example. We've talked a lot recently about decision making. So be mindful of your limitations of your knowledge, even if you are a buy and hold investor. Because if you're a buy and hold investor and you don't understand how markets work, then your ability to assess the performance of your portfolio or your likelihood of achieving your long-term goals, for example, that is hindered. And you only have to go and look at the reviews of a lot of robo-advisors online to see that, because during bull markets, during periods where markets were flying, the reviews of these services are overwhelmingly positive. You'll see 5-star reviews galore, but if you go and look now, and just do this while you're on the podcast, because it will just prove the point, you will find that almost across the board, whichever robo-advice proposition you look at, whether it be Nutmeg, whether it be Money Farm, you could even look if you can find reviews about things like Vanguard. There'll be reviews in there where they're complaining about the performance of the portfolio, but it will be largely a function of the market. And actually, we look at the performance of different robo propositions and we look at it and benchmark it against other performances, and you can see that some are significantly outperforming others. So it's by understanding that, increasing your knowledge, that you can then make these assessments, not just about performance or your likelihood to achieve goals, but also other people's. And it's important because one takeaway obviously is that if you are mindful of your own limitations and your own knowledge, that you go and seek expert advice. You might go and see a financial advisor, and I'd always recommend that if you're not comfortable making your own decisions. But at the same time, this whole effect isn't just applicable to consumers, so the people listening to the podcast, but also to the experts out there. So financial advisors, for example, they are human. They will have this effect too. They should be able to show you objectively their performance, be able to assess it, how things are going. So that is something you should ask them to do objectively as well, because they should be able to. I just want to emphasize the point that this evidence isn't about beginners making bad decisions, although that is obviously possible, but it's about the inability to recognize performance. And ultimately, you could take one step further, recognize bad decisions are being made, because that is important in finance as well. So don't be put off investing. There are lots of propositions out there where you can outsource this sort of thing. You can go and buy and hold robo-advice propositions. There's companies that have got tracker funds. There's a whole host of services that you can use, and we'll put links as usual in the show notes. But the other thing that I want to lead on from this is just to highlight one or two things that people with a little bit of knowledge, there is an element, yes, that they might make bad decisions, but it has been shown that they are more likely to use leverage. And it has also been shown that a fifth of young people, young, I say inverted commas, are likely to take share tips from Instagram. That was a headline I saw just before I started this podcast. And they're more likely to buy high risk investments. So it's an important takeaway. It's the type of knowledge that you've got as well. So if you're taking knowledge from Instagram that's pushing high risk leveraged investments, which is often what you will see, and they're telling you that's the way to get rich, it doesn't matter how much of that you consume, it's likely to have a negative outcome. So always keep learning is the message. Even if you are a buy and hold investor, if you're not, if you're more active, then you want to be continually learning. What is interesting about this phenomenon is that in the planning stage of, let's say, a financial decision, then that is where the overconfidence is a real issue. So if you are planning, so you're going to make a financial decision, then it's important to gather information and learn. In the execution phase of, say, investing or a financial plan, then the overconfidence isn't as much of an issue. So the Dunning-Kruger effect is something that's more of a problem at certain points. So that's why I want people to be aware of. So to give you a real life example, if you imagine a battlefield and the general's going to make a plan for what's going to happen in the attack in the morning, if they're overconfident, then you can obviously guess that the results potentially could be disastrous. If they have all the information and they make a strategic plan, then the overconfidence in that plan in the execution phase can mean that the plan gets carried out, if that makes sense. So the overconfidence is a problem in the planning stage. That's where you can get real problems. But if you are confident in the plan, you've gained knowledge, you've thought about all the pros and cons, and then you execute the plan, then being overconfident in it isn't as much of a problem. And I think if you take that to somebody who may be a long-term investor who's dripping money into the market, then it's about staying the course with their plan. So having confidence in that. So I think it's an interesting phenomenon. Be mindful of it. Use the 6 hats process that I spoke about a couple of weeks ago if you want help in making a robust assessment about situations. If you don't have your own process for making financial decisions, because that can help you avoid this overconfidence and lack of information and lack of learning. But more importantly, don't let it be used incorrectly by marketing material to force you to go and buy services that you don't probably need, or put you off of doing something like investing altogether.
Okay, so the next piece is consumer duty. It's kind of a buzzword that we've heard floating around, but there are probably a lot of people that are very confused by it. What do the new rules mean? Damien, you're going to summarize it.
I'm going to do the best I can to summarize it, Andy, because like a lot of things in relation to compliance in the FCA, it's never black and white. It's always a shade of grey. Now, just over a year ago, the consumer duty was released upon the financial world, and it's this new principle and a series of rules and objectives or outcomes that the FCA want to happen in regulated firms. And it was released a year ago, but we've only really talked about it now because it's come to implementation time. So there's been this period where firms are having to get everything in order to comply with this consumer duty. So what I want to do is give a very high level explanation as to what it is, and then who it applies to and how it therefore impacts consumers, so listeners. So starting off with the consumer duty, it is this new principle, and the quote from the FCA that probably best summarizes it is that their new duty sets higher and clearer standards of consumer protection across financial services and requires firms to put their customers' needs first. And the aim is really to change culture in firms to ensure that consumers' interests and outcomes are clearly focused upon. So that's the high level aim of this consumer duty. And what does it apply to? Well, it will apply from the 31st of July 2023 to all new products and services and all existing products and services that remain on sale or open for renewal. But importantly, it would also apply to closed products and services from the 31st of July 2024. So there's this retrospective element to it. And it applies to regulated firms that provide services to retail customers. So that's basically the listeners. So you've got to think of things like investment firms, fund managers, banks, building societies, insurers, essentially regulated firms. But it also covers firms throughout the whole chain of production. So it can be the design, operation of products or services for retail consumers, the distribution of those things, the preparation and or approval of communications that are sent out in relation to these products to consumers, and also the support that's provided to consumers, which is a big thing. So what does that mean for consumers? Now, there's a series of terms and rules I'm not going to go through because a lot of acronyms and you don't really need to understand it. Ultimately, there are 4 outcomes which are the key requirements which firms must demonstrate in order to comply with their duty requirements. And they are in relation to the quality of products and services. So that means they've got to ensure that all products and services sold to consumers are fit for purpose, which means they've got to be designed to meet consumers' needs and targeted at those consumers whose needs that they are designed to meet. So going back to that chain that I just mentioned, everybody throughout a product development, so if you're talking about a credit card, that could be Visa, for example, then the credit card company themselves and the way it's communicated all the way through, they've all got to comply with consumer duty. It's got to mean that the products are aimed at a specific targeted audience and they are sold to those. One of the benefits, which I will mention later on, it should hopefully reduce mis-selling as a result. Interestingly, that supply chain that I mentioned, so up to the point where you are as a consumer will have a product or service, each firm within that is responsible for ensuring that if they are aware of another firm within the chain that isn't adhering to their consumer duty, then they will report them. So there is this element of, I suppose you could say whistleblowing that's being encouraged within the financial services, which is a positive from a consumer point of view. I'm going to move on to the second of the 4 outcomes, price and value. So this is to ensure that all products and services represent fair value. And the third is consumer understanding. They need to ensure that communications with clients consistently support consumers, enabling them to make informed decisions about financial products and services. Now, to give you an insight there, with the average reading age in the UK being 12 years old, it means that the communication has to be appropriate for them to be able to understand what it is that they're reading. So obviously that is positive. We should hopefully see less jargon. One thing to point out is that good firms should have been doing all of these things anyway, and they will have been doing all of these things. What the consumer duty does is start to create a framework around which the FCA can start to take action against firms that are not doing so. And consumer support is the fourth outcome, and that's to ensure that firms provide a level of support that meets consumers' needs throughout their relationship with the firm. So that means that you should be able to contact a firm if you are trying to. This comes off the back of a bit of research that the FCA did, which showed that 7.4 million people have unsuccessfully attempted to contact one or more of their financial services providers in the 12 months before May 2022. So based upon that research, that was what the scaled up number would be. We can all relate to that. So the consumer duty should hopefully mean that you aren't left hanging on telephone lines, for example, where you eventually give up and don't end up contacting the company that you're after. So let's think, what does that look like in real terms for consumers? Well, in a press release, the FCA actually stated one or two of these things, and it included the end of rip-off charges and fees. So the consumer duty should hopefully mean that they can take action against rip-off charges and fees. It should be easier to switch or cancel products, which for me, I think is a huge benefit of the consumer duty, assuming that it is enacted and the FCA makes sure that it is, because one of the problems that consumers have, they end up buying products and they can't switch and change. They should provide helpful and accessible customer support, not making people wait so long that they give up. That's what I mentioned earlier. Provide timely and clear information about products and services that people can understand so they can make good financial decisions, rather than burying key information in lengthy terms and conditions, which few people have the time to read. And the products and services need to be right for customers, so it reduces that risk of mis-selling. So they are all positives. I think if I had to summarize from all of my contact with various different compliance departments at different firms, understanding the impact of consumer duty, it's very early days, so we don't know exactly what will happen, how it will impact the industry. I think products are likely to change. One thing I would say is, in the past, a lot of regulation was about companies not providing bad outcomes for consumers. So it was avoiding something going wrong that people would complain about. The consumer duty seems to have shifted that, where it's more about promoting positive outcomes. So it's not just about not doing things that are detrimental to the consumer, but also positive and helping them achieve their financial goals. So you should start seeing a lot more signposting. So signposting is where you will get a company, let's say they can't offer you a product or service, that they'll point you in a direction of information, for example, or maybe another service that's provided by somebody else that might meet your requirements. So regulated firms are needing to comply with this new duty. It'll be interesting to see how that pans out going forward. It is worth noting that the duty is underpinned by a concept of reasonableness. So firms are not expected to go beyond what would be called reasonable for them. So, for example, the FCA will not require a firm to take action beyond its permissions or the scope of the service they are providing. So when they say permissions, that means if they're regulated to give, say, investment advice, then it's to do with that area that they are looking at. So they aren't expected to go beyond that scope with respect to their consumer duty. So overall, positive movement. It could mean that some products that we see may change. I've seen articles, reports where people are trying to use consumer duty to, say, for example, attack the active fund management world, arguing that excessive fees are not in the interest of clients. I can certainly see that if something is a closet tracker where a fund is effectively just tracking a benchmark, even though it's supposedly meant to be actively managed, yet they're charging excessive or higher fees than a tracker fund. And there are others, but I won't go into them because the danger is, I think people at the moment are having to wait and see what will happen with the consumer duty. Now, just to liken this to something that most people understand, which was GDPR, in a very loose way, that gave a framework which dictated how companies had to deal with your data or could communicate with you. And so people understood that, but it meant that the good guys kept doing it how they were doing it, but the companies that were doing things that were frowned upon or misusing that data had to come into line. Consumer duty does a similar thing in terms of trying to get people to be working in the consumer's interest. So it is a positive move.
Okay, so the final piece of the podcast this week, we're going to be talking about joint savings accounts. We've covered savings accounts before, and we've been talking about how interest rates on savings accounts are on the up, which is great for consumers. But actually, a few people have been in touch to say, look, I've looked at the best rates available. I've seen some joint savings accounts. Should I go for it? What are the benefits? Damien, you're going to just summarize this.
Yeah, so one of the questions came via YouTube, actually, where somebody asked about what are the best joint savings accounts. And when we looked at it, we suddenly realized we'd never produced a list of the best joint savings accounts, which felt like a glaring omission. And then when we looked into it, it was a much more convoluted request than we'd imagined, because most savings accounts can't be held in joint names. So before I delve into this, I just want to mention something that Andy and I were talking about, and actually I'll bring Andy back in on this, was that there had been a slightly interesting shift, because we were looking at other content we'd done, cash savings ladders, where we did a piece that talked about spreading money across different fixed rate bonds with different terms to boost your savings rate. So a year ago, the 5-year fixed rate bond was offering way more than the 4, 3, 2, 1. It was tiered up. So the longer you locked your money away, the better the rate you got. And then we started looking at ways you could boost the interest rate on your savings without locking it all the way for 5 years. And that was using this idea of a cash savings ladder. We'll put a link in the notes. I won't go through it all now, but effectively you spread your money across the different products of different terms, and then you get an average interest rate. There's a little bit more to it. But Andy pointed out something very interesting that's happened in the savings market at the moment.
Yeah, that's right. Essentially, I was looking to update the article because we were coming on to the podcast today to talk about savings accounts. We're updating articles on the site all of the time, and it was interesting to see that although interest rates are flying at the moment, and it's great news for savers, the way that interest rates have risen so quickly, and also what the future expectations is on where interest rates will be in the future, it's actually meant that there's been a shift in fixed rate savings deals. So whereas, Damien, you pointed out earlier, the best rates this time last year were for locking away your money for longer, if you look at the rates as of today, the best fixed rate savings account deal you'll get is actually on a 1-year fixed. And as you go to a 2, 3, 4, 5, that pattern is reversed from last year. You actually start getting slightly worse rates for a 2-year and a 3-year and a 4-year and a 5-year fix. And that's because of future expectations on where rates will go. And obviously banks are less keen to provide you a guaranteed rate for that longer period.
And what is interesting, that's reflective of the mortgage market. So we've now seen the point where short-term mortgage rates are higher than longer term. So 2-year fixes are higher than 5-year fixes. And so we're seeing that reflected in savings accounts. So I just thought we'd mention that on the podcast, because unless you're like us and you update savings rates and look at the best accounts every week, we'll put a link to that article actually in the notes, because every week we update the article on the best savings rates in the UK. Unless you're all over it like we are, you won't know that there's been a shift now, and actually the sweet spot is no longer 5 years when it comes to savings accounts. It's now around about 1 year. But moving on then to joint savings accounts, we started to look at them And it's an interesting request because not all savings accounts offered out there can be held in joint names. So I want to just quickly go through the pros and cons before I just give you a few of the best ones, because that will date the podcast. So I want to give a bit of insight before I do that. So what are the pros of having joint savings accounts? Well, obviously it means you can save with a partner, for example. It could be a friend, spouse, roommate, whoever it is you want to save money with. And for example, when I first bought my house many years ago, my now wife and I saved into a joint savings account for a deposit for that house. So that was a very long time ago, like I said. But there are negatives to that, which I'll come on to. There are advantages to joint savings accounts as well for people. Let's say, for example, you may be married or you've got a partner and you have joint savings. If you were to put them in your sole names and one of you were to die suddenly, then the other person doesn't have access to those savings immediately. So it may go obviously via your will and then through probate before they get access to the money that's in your sole account. If you have a joint savings account, obviously they could access that money straight away because they would therefore, as a joint account holder, would be the joint owner of that money as well. So that is something to bear in mind if you are putting large sums of money aside to try and get the best rate. The other thing which people might not realise is that you may be able to get a higher rate of interest. The reason it's possible because there are accounts out there that offer tiered interest rates, which means the more you have in them, they may offer you a slightly better rate. A good example is NatWest's Flexible Saver, which currently offers 3.14% interest for balances over £250,000 compared to 1.41% on balances under £25,000. And Tipton Building Society offer 5.5% on balances over £25,000 compared to 5.3% on balances under £1,000. So if you were saving money together, it could be rather than having those accounts separately, if you had them together as one joint account, you'd actually get a better rate of interest. So that's something to bear in mind. It's not necessarily a reason to do it, but if you're holding them separately anyway, it may be something to consider. Now, the cons are there are fewer accounts out there that offer the joint option. Also, if you take out a financial product with somebody else, so if you take out a joint savings account, you become financially associated with them, which therefore can negatively impact your credit score if you were to then try and borrow money, if that person has a poor history with credit. So it is something that is not to be entered into lightly. Also, if you have a joint savings account, both people have access to that money without necessarily having to tell the other person if they want to withdraw the money. So if there's a dispute, that could cause a big problem. If you're in that situation, then you should notify the bank to see if you can set it up where both people have to sign to have the money removed from the account. And also the other thing is, as a joint savings account, you might not necessarily get the best rate because there are limited offerings out there, and the ones that are available, they aren't necessarily on the best savings rate tables, and most of the time you can get a better rate as a individual with a savings account. And the other thing to bear in mind is the FSCS protection, so the Financial Services Compensation Scheme, because at present you get £85,000 per person per banking licence that is covered should that banking institution go bust. And a joint account, that is doubled to £170,000 because obviously you've got two people and therefore twice that cover. But if that person, for example, had money with HSBC and you had some money with another company, and then you decided to get a joint account together with, for example, First Direct, HSBC and First Direct share a banking license. So therefore, you wouldn't have double the £85,000 protection on that First Direct savings account that was joint because the other person has a savings account. Let's say they had £85,000 with HSBC. From a Financial Services Compensation Scheme perspective, they would be better off opening a separate account somewhere else, or your joint account with somebody other than HSBC or First Direct. So be mindful of the FSCS protection. The other thing I did mention at the start of the piece about saving for a deposit. Now, if you are under the age of 40 and you will be a first-time buyer, then it is possible to each have a lifetime ISA. So you can put £4,000 a year into a lifetime ISA and you get a 25% uplift from the government. So that means an extra £1,000 taking it to £5,000. But as a couple, you can each have your own lifetime ISA. So that means that if you were to put £4,000 into your own lifetime ISA and your partner did the same thing, yes, it's in your own names, but you will get an additional £1,000 each, which would mean, before we even talked about interest rates, you'd get £2,000 added on top for free that year. And of course, every year you can keep topping your lifetime ISA up and get that bonus. So that's something to bear in mind. Now, a quick run through of some of the best savings account rates you can get at the moment. Regular saver accounts for joint, you can get 7% on the First Direct regular saver account. If you're looking for a joint fixed rate bond, Oak North do one, and that is a 12-month fixed term savings account. So that's 6.02%. Goes back to Andy's point earlier on about how there is a sweet spot around the 1 year mark at the moment. If you want an easy access account, so you want a joint easy access account, then Synergy Bank offers 4.8% with a minimum opening balance of £1. And if you want an instant access account, then Barclays have a rainy day saver offering 5.12%. Again, minimum opening balance of £1. And we'll put a link through so you can see the other accounts that we've listed, but also see all of the T's and C's on the accounts that I've mentioned.
Okay, so there we have it. That's it for this week's podcast. If you want to get in touch with Damien, you can do so in the usual way. It's damien@moneytothemasses.com, or you can contact me. It's andy@moneytothemasses.com. We will put notes to everything we've talked about in the show notes of this podcast as usual, or you can go onto the Money to the Masses website, search episode 427, and all of the details and resources will be there as well.
And just to remind you, there will be something a bit special next week because we're not able to record live during the week. But if you have children, I think you really do want to listen to that episode about how you can teach them about money. So that is it, Andy, for this week. And so all that's left for us to say is until next time.
Until next time.